Good morning and welcome to another edition of Fast Market. It's Thursday, August 9th. I'm Tom White, co-host of Fast Market. I'm joined on set today by Scott Bauer, the CEO of Prosper Trading Academy, and Dan Sebulak, a senior risk analyst for the financial risk management team here at TD Ameritrade. That's a long title, Dan. I'm not reading that again, by the way.
What do you put on your business card?
I'm not reading that again. All right, guys, let's get started here today. Not a lot of earnings out. Not a lot of economic data. I guess there was a PPI number, but let's go ahead and take a look at the overall market in general. Scott, stocks up once again.
I mean, this is unbelievable. And you know, in any other time period, any other summer like this, you'd expect to see VIX sub 11, maybe 10 handle, maybe even a little bit lower. But this year has been anything but the norm.
Right.
There's so much geopolitical risk, tariff talk, this, that, and the other, yet we are seeing where we were back late January in the VIX, and the market is just grinding itself higher.
Right, we've got the S&P 500 and the NASDAQ both near all-time highs, less than 0.5%, Dan. Do you think this headline risk is getting pushed to the side a little too quickly?
Well, it's definitely an interesting time because you mentioned that VIX has lit the lows late January, and then you had the February event.
Right.
And if you guys remember, just not too long ago, a week or two ago, we were right around this level, about 10 handles away, and we pulled back with the market with Facebook and Netflix.
Right.
Apple and Tesla came to save the day. So now that we're getting close to that all-time high again, brings some interesting opportunities, some things to look at with these levels.
Yeah, and you should know, I mean, being part of the financial risk team, what I see is as the equity market grinds higher, we're seeing people taking more risk on type of mentality. Sometimes that's good, sometimes that's bad. We like to talk about actually hedging those particular positions when you're reaching all-time highs, but do you see that in your world where it's complacency? Is that a danger?
Absolutely, because those tail risk situations can come out in a Facebook chasing gains that it's shown since, I mean, it feels like there was no pullbacks after its IPO from 15 all the way to 180.
Right.
And then we give up a whole year and a day.
Yeah.
So, you know, Stephanie talked about this in the previous segment with volatility so low that it's a good, potentially a good opportunity if you're worried about volatility expansion.
Right.
To go out and look and protect your portfolio.
Right. Dan brings up a great point, Scott. The ability to hedge or to maybe lay off, take profits at this point,
Yep.
It's right in front of you.
Yeah.
You don't have to look too far for the opportunities to take advantage of maybe taking a little off the table, maybe hedging.
Yep.
If you're still bullish, you can still get in. You know, volatility is relatively low if you're trading options. Pretty cheap right now.
I am totally of the mindset, have been since my first day on the trading floor eons ago. Bulls and bears prosper, pigs go to the slaughter. This is that perfect scenario for
Right.
that, right? It's a great time for stock replacement. If you've been in the market, especially in some of the techs that have really grown, have really accelerated, why not take some off and actually buy upside cheap calls if you want as a stock replacement.
Right.
If the stock goes up, okay, you sold your gains, you still have upside exposure. If it goes down, then you exit it at a great point. So to me, it's not just about going in protecting from the standpoint of maybe buying puts in the marketplace. Right. I think this is a wonderful, wonderful opportunity for some stock replacement.
Right, and I always look at it this way, guys, where you've got gains in your portfolio to take a little bit, a couple percent, maybe 5%, and protect your portfolio. Never a bad idea in that regard. Now, so it's not a complete risk on trade because Treasury market is actually up today. And this is based on maybe the weaker than expected PPI number. Dan, do you see this advancement in not only equities, but now the Treasury market too? Is it just investors looking for someplace to put assets?
I think so, and we saw that the 10-year get up to 3%, touched it twice last week and kind of gets slapped down, so
right.
A little bit of an area of congestion. And with today's PPI number, you know, maybe some steady interest rates until that September 19th FOMC meeting.
Yeah, I think Dan makes a good point there, Scott. You would expect, now we had a 10-year auction yesterday. It's about average,
Yep.
A little bit of demand. But it still seems like investors, while they're reaching out for equities right now at elevated levels, near record levels, they're still reaching out for treasuries too, while we've got a solid GDP, economy's doing well, and low unemployment. Your take on that?
Yeah, they are. They're looking for return at some point. And I think part of reaching out for the treasuries may be some of that risk off from the overall market, taking some money out of the equity market. Now, Dan, you make a great point. When we got to these levels back in January and the VIX was down here before the February drop-off, what did the market freak out about? The psychology of the market was, oh my God, 10-year is 3%. Now, that's just an afterthought, right? So that all plays in also to the psychology of trading, right? If we hit 3% again, as we did just a week or two ago, right now, it's irrelevant to the marketplace.
Right.
Where 6 months ago, it was the end of the world.
I know. It's funny how during these times when the market rallies like this, we'll see headline news get pushed away after a week, and then the next time it rallies, it gets pushed away in 2 or 3 days, and then it's a day, and then it's 3 hours gets pushed to the side. So you got to watch that if you're an investor and you're in this market with it at all-time highs. Now, that being said, the economy is doing well. Like I said, we've got low unemployment, and also corporate side's really doing well right now. Tax cuts really taking hold here. Now, let's pivot over to oil. So it's flat today, but it wasn't flat yesterday. We saw oil dip to nearly, I think at its lows it was down about 4%, Dan. I think it finished down about 3.3%. Your take on this crude trade, because the inventory wasn't, the inventory data that we saw out of the EIA yesterday wasn't bad. API, we saw a big draw in inventories there. But what do you think the underlying tones here for oil is, and why we saw that big drop?
Well, we still have some volatility from its last pullback from the 70 handle to about low 60s. So volatility is still mid-range, so we should see some back and forth trade. But we had some headlines come in where China said that we were potentially looking to put some tariffs on imported oil. And then we had some exporters saying that we're not going to be able to slow down the exports. So maybe that was contributing to the downward pressure, although that was a rather big move yesterday.
Right, and I think there was a report today that on China's list is not going to be oil, because they still need that for their economy, and they're the biggest importer of crude at this point. Now, Scott, with that volatility thing that we're kind of touching on, we saw it yesterday in oil. It was It was a crazy day for the oils, and I think a lot of speculators were in this market. Maybe that's why it exasperated that sell-off a little bit. Your take on oil yesterday?
Yeah, no question. I mean, it was one of those outlier moves that we saw yesterday, especially since we've seen the oil market really consolidate over the last week or two. This was one of those outlier moves. If you look at the chart here, and I think you're bringing it up here, if you look at this chart from about February on here, you see that we're making higher highs and higher lows.
Right.
It's pretty well defined here. So if I look at this, I say maybe this is an opportunity to get into oil. That being said, there's also, in my opinion, a put below the marketplace because of the geopolitical risk right now, because of what's going on in Iran. So to me, this could be a really good opportunity. Not that we're going to see 72, 73 again in the near future, but to get back up to that range that we were trading in.
Right. You make a good point there, Scott, and I'm going to go have Ryan go to our trading platform here. And we've got some positions on an oil based on the fact that oil was trading in that $65 to $75 range, and it's tightened up a little bit. We're short an iron condor in there. We're short the 64, 62 puts in the October futures options, and then we're also short the 73.75 call vertical and the 74.76 put spread. So we've got a range-bound trade in there. But now I always tell people this: if you're not going to trade futures, what kind of proxy can you look at to trade maybe a commodity or some other product? And I looked at Chevron, and we're just going to look at an example trade in here based on what Scott's potential assumption is on oil maybe rebounding, because there's still a lot of geopolitical risks. There's a lot of headline risk. Iran, that's 1.5 to 1.8 million barrels coming offline soon as the sanctions start ramping up that the U.S. is imposing here. So I looked out to about the September 7th weekly cycle. This is about 29 days to expiration here, Ryan, if you want to go to the trading platform. And ways that you can trade. Maybe you're not comfortable with trading futures options. It's a little bit different. You have to have a futures account, right? So you look at proxies, you look at Exxon, you look at Chevron here, Dan. So what I'm looking at is something that hits all of our pillars when we're talking about example trades. Risk-defined in nature, high probability of success, and then also you have to look at probabilities in your favor, but also rising volatility in this particular name also helps. But we want to stay risk-defined, we want to collect time decay, and we want to have a high probability of success. Those are the pillars that we looked at. So I looked out to about the 120 strike in CVX here, and I'm going to look at a short put vertical. I'm just going to right-click on that and sell vertical. So that'll populate the 120, 119, but I want to widen that out a little bit. Maybe on that protection, I go down to the 118 strike. You're roughly collecting about 48 cents, a $2 wide put vertical. Let's go ahead and analyze that, guys, so the viewers get an idea of what we're talking about here in this particular name. And I think we've got a couple trades already built in there. But there we go. There's our short put vertical, $2 wide, collecting 48 cents. Your risk is $1.52 to the downside. But you got some cushion on that potential trade, Scott, and we're looking at probabilities over 70%, which we like. But that's a standard profit and loss graph of that short put vertical, bullish in nature. And it's a good proxy because if you correlate CVX or Exxon to oil, it kind of dispersed in 2017, but it's back to that high correlation rate. So this is an example. So we'll put a 4 lot in there, and what we'll do is we'll monitor this trade. We'll show you some trade management skills as it comes to closer to expiration. But this is a way to play oil maybe rebounding a little bit. Now, if you're bearish on oil, maybe you sell a call vertical on the same name, or maybe buy a put vertical on the downside if volatility is low. Those are ways to play that. Dan, go ahead.
And I like the way that you set that up. You initially set up the spread as a 1 point wide put spread, and it lined up at about a 26-cent credit. So giving us an indication that relationship between price and probability, where we have greater than a 70% chance of success. And then you can widen it out from there if you're more risk tolerant or less. So I like the way that you set that up in your approach. That's
a good point, Dan. And then also you can change the number of contracts that you're comfortable with. Maybe you have more risk tolerance and you want to do a 20 lot or a 30 lot. It all depends on what you're comfortable with. And as we always like to say, if you're trading risk defined, it's a sleep at night type of scenario, right?
Sure is.
I'm comfortable with that risk. So we're going to go ahead and confirm and send that and see if we get filled on it. But that's one of the a good proxy trade for oil if you think it's going to rebound. Nice fill on that one. So now, guys, let's move over to economic data. Now, we had Ppi data today. It was kind of a wah-wah type of number, Scott. Your take on the Ppi was basically flat. They expected a little bit of a rise, but the core was up 0.1. I think that met expectations.
It did, and what was a little bit surprising to me is actually there were no revisions.
Yeah.
We typically see some revisions. So what does that tell you? You know, without having to read into the tea leaves here, does that tell you that the economy is just kind of motoring along here, and what we see is what we get, meaning that there were no outliers in last month's number? Is that a good thing? It probably is. It means that we're just steady, and the market likes steady. The market does not like uncertainty. So this number that came out, you know, we hear that term Goldilocks number all the time.
Right.
This probably fits right into that.
And we've seen that out of the CPI lately. It's been one of those not too hot, not too cold numbers, but PPI had been hot recently.
Yep.
But now we're starting to see that number, those numbers on the producer side starting to, fail, maybe pull back, and one of those, like Scott said, Goldilocks numbers. Now, do you think PPI is having that effect on treasuries where it's capping yields a little bit? You're getting a bid in treasuries right now. Yields aren't rising. They're actually coming down because it's not a surprise or hot number, Dan.
Yeah, and we've been chopping sideways in the 30-year since last week or 2 weeks ago when the 10-year got sold off when it touched 3%.
Right.
No real announcements till the September FOMC meeting, so that's what I'm looking forward to, and maybe a range-bound trade until then.
That doesn't sound like a bad idea, right?
Nope.
You've got the Fed out there. I think it's about 93% chance that they're going to hike in September. All the data is kind of aligning with that. How do you trade that? And I think I'm actually going to go to the trading platform, Ryan. I just want to look at a position that we have on in /ZB, which is a 30-year bond future. And I think we have a position on in there, and I'm going to go ahead and take a look at it. Yep. what we are now is short a call vertical in there. It's a little bit above the market right now. It's starting to creep up a little bit, but we're pretty comfortable with it. We're outside of our range, our break-even point on that, which is above 144 for that 30 years. So expectations that maybe data stays relatively flat, Goldilocks type scenario. You know, and I think there's always going to be demand for our treasuries, don't you, Scott? Where we've got the best yield.
Right.
We're the best in the best in class, you could say.
Best in class, I'd say, because of safety. Right. Whether you're getting a 30-year at 310 or 305 or 330, it's really the safety that's there with our treasuries. So I think that over the next 6 weeks, which probably takes us right about to that Fed meeting, that September meeting, maybe it's 5 weeks, I think we have to be range bound.
Yeah.
You know, obviously there could be some outliers. Maybe there's some major happening that happens with China. Either the trade situation gets completely resolved or it really accelerates. So that certainly is some of the risk to the marketplace here. But I think a trade like this here going out to September, a range-bound move is the right thing to do.
Right. Okay, guys. Big story today on the chip sector. We had the Morgan Stanley analyst come out and say, maybe this sector has been pretty hot lately. Hey guys, Ryan, if you guys can hit up the SOX, which is the Philly Semiconductor Index, you do a 5-year chart for me on that one. But we're going to take a look at that because over the last 3 years, that 2.5 years, the SOX or SOX has risen about 130%. Yep. Outperformed the overall sector, outperformed the overall market, the S&P 500. Your take on this, because we're starting to see some haves and have-nots in this particular space. Upgrades in AMD, downgrades in Intel. Dan, your take on this particular sector, and is this guy just picking a top because maybe the market's up at this point, or do we see some headwinds for this sector? Well,
you know, he said pigs get slaughtered. I'm not saying that the gains in there are necessarily piggish at this point, but 130% over the last 2 years is pretty significant. One thing that I would say is that, you know, Intel had a big drop following their earnings.
They did.
And somewhat rallying back. When we look at this chart of the SOX, we had that similar drop, and now we're approaching that gap in the chart that we see that happened at the end of June there. So similar patterns between the two, potentially an opportunity where these higher beta stocks, the chip makers, maybe if we're looking to rotate out of some of those in our portfolio, we might move to a lower beta security.
Yeah.
Or look to capture some gains that we may have realized in our portfolios.
So Scott, he pointed out inventory issues, their inventory starting to build up, maybe some pipeline issues as far as getting those chips out. I know Intel had some problems with their 10 nanometer. Now, don't ask me to explain that, but I know they had some issues as far as development of that. Your take on this particular sector?
So overall, it's hard not to like the sector. Now, if you've been in for the ride here, yes, from a risk management tool, you have to look at it and say, maybe it's time to take a little off. Not necessarily because it's so bearish, and I don't look at this Morgan Stanley call as being necessarily bearish, as I look at it as much as risk management. So what we talked about before with stock replacement, you can absolutely do the same thing here. If you've been long equities in here, you can sell the equity here, take a little bit off the table, and buy some really cheap upside because the volatility in the SOX, volatility in this entire index is still incredibly cheap.
Yeah, I mean, you look at that VIX right there and it tells you, and this particular sector has outperformed so much. I like the thought here, and that's great for the viewers to take a look at something like this where, hey, it's never a bad idea to take some, take some profits off the table, maybe cover some risk. But it all depends on your assumption. If you think this is going to continue higher, because we've got spaces in this particular chip sector, right? We got AI, we got autonomous vehicles. We've seen that diversion from some of the stocks, Intel versus AMD. You got AMD rising, Intel kind of hitting a rut here. You got NVIDIA, the gains that you saw in NVIDIA over the last couple of years because they're diversifying their business as far as chips go, whether it's gaming, autonomous vehicles, like I said, or AI. So I think it might be one of those, and just reading his note, it might be one of those haves and have-nots moving forward because the business cycle is still pretty strong and the demand for the chips is still there. But I kind of wanted to take an example of a trade based on that report out of that guy. And Brian, if you follow me to the Thinkorswim trading platform, I'm going to take a look at Intel. Now, we always talk about positive time decay, right, when we're doing directional trades. Selling put verticals for a bullish to neutral stance, selling call verticals to take a bearish to neutral stance, right? But when you got volatility relatively low, and I'm going to go down to the option statistics page here, you got a current IV percentile rank in Intel is about 31%. The 52-week range is about 12% to 41%. So we're at the low end of that range. Current implied volatility down here, 21.37%. Now, if my thought was to listen to that particular analyst and say, oh, maybe I'm thinking about taking some profits or covering some of my risk that I might have in the overall market or this particular sector, if I start looking at selling a call vertical in there and I use my probabilities of success, if I sell that 52.54 call vertical, and I'll just go ahead and do that, just to kind of show you ways to take advantage if you have a directional bias. So I'm going to sell the 52.54. It's $2 wide. I'm only collecting 28 cents,
Exactly.
guys. Risk reward on this particular trade, not the best in the world. Now, some people are comfortable with that, but I'd like to collect a little bit more if I have that much risk on. So you got $1.72 in risk to make only 28 cents. And I'm going to go ahead and analyze that particular trade. And there it is. So you've got this potential reward if it goes down. You've got good probabilities, but look at the risk compared to the reward. Probably not ideal. So with low volatility, maybe I turn this around and I buy a vertical if expectations are that Intel might fall. And one of the trades that I looked at was buying this vertical. And I'm buying the 51 strike and I'm going to sell the 49 strike. It's $2 wide, just like my short call vertical. I'm paying roughly about 92-cent debit. So I've got a better than 1-to-1 risk reward ratio because I'm paying less than $1 for this. I'm risking 92 to make $1.08 on this. And why do I buy the 51 strike? Because it's already in the money, right? Time decay is working against you in this particular trade. So not ideal, Scott. But with the directional bias of this, all I need is maybe a 1 to 2% down move, and this thing expands by 30, 40%
Yes.
in my favor. And I've got plenty of time. I got about 29 days until expiration. So let's analyze that one. So here's the risk reward on that. Now, this is a pure directional play as opposed to positive time decay and taking advantage of probabilities. I still have a decent probability that it's going to fall because you can look at the trading platform, and instead of looking at probability of finishing out of the money, I'm going to change this. I'm going to go to this column right here, and I'm going to go to option theoreticals in Greek. I'm going to have probability of touching, because on a purely directional trade like this, guys, I only need it to go down for 5 minutes, maybe 10 minutes for this thing to expand pretty significantly. And the probability of touching my 49 strike, which would be make this completely in the money, is 69, 70% basically. So you do have decent probability in this, but time decay works against you. So that's a way that you can take advantage of maybe a directional move in low volatility environments. We talk about calendars are good for this also, Scott, but this was just an example on maybe buying a vertical as opposed to selling one. All right, guys, that wraps it up for this segment. Coming up next, we got face-off. We got technicals versus fundamentals. Ben Watson joins us from Salt Lake City. We're going to talk oil. We've talked about it already, but we're going to talk about oil stocks. Stay right there, or stay right here on the TD Ameritrade Network. Fast Market will be right back in 2 minutes. Welcome back to Fast Market. I'm Tom White, once again joined by Dan Sebulak and Scott Bauer, the CEO of Prosper Trading Academy. Okay, guys, just a quick market update. Nothing's really changed. It's the theme of the day is maybe low volumes and low volatility at this point. Scott, your thoughts?
Absolutely, and this is the time that also, unless you really have an axe to grind in a particular position, don't force anything. There will be other opportunities.
That's a great lesson.
It really is. There's always going to be another position, another trade to make, and you don't want to force anything when there's no volume, no volatility per se.
Right.
Just sometimes it's better to stay out away than force that trade.
That's a good lesson, I think, for our viewers. Dan, and being in the risk department here at TD Ameritrade, you kind of see that where maybe people force things when nothing's really going on. Unless you have an axe to grind, maybe the best trade is no trade at all.
Yep. And something that I've learned from, your former cohorts in Left Floor.
You can say it, Dan, old dudes that work here, yeah.
But make your money in the first and the last quarter of the year, right? And a lot of times when we see such suppressed volatility levels, you can have that idiosyncratic risk in single securities that can have that tail risk of move, that snap of the rubber band.
Right, and you're seeing it in some names. Like it wasn't a big day for earnings today, but we did have some results from Yelp and Roku, and those stocks just spiked. There was some short interest in those names. But there are opportunities out there. And then I think next week we really start ramping up with some of the retailers, some of the Walmarts and Targets, they start reporting. So we should get some more activity in some of the bigger names next week. This week was kind of dull as far as earnings goes. But I kind of want to switch the conversation, guys. We're going to talk about home builders, a sector that has underperformed the overall market. And you would think in an economy where it's 3.9% unemployment, jobs market's doing well, GDP hit 4.1%, but you've got home prices at all-time highs again. And over the last year, we've seen that 30-year mortgage, that fixed mortgage rate go up to above 4.8%. And inventory issues. Scott, your take on this particular sector, maybe why it's underperforming, what type of factors do you look at?
There's no question that the reasons you just mentioned is why it's underperforming. Higher rates, way more demand than there is supply on the market, and higher ticket home prices. So all of that being said, how are these stocks going to do? The Toll Brothers of the world, how are they going to do? Now, we're coming into, maybe the latter part of the cycle here with rates leveling off, it seems like. I mean, it's, 93% chance that they're going to raise rates next month. So that is probably already priced into the marketplace. Maybe we'll see a little surprise in mortgage rates to the downside, actually. I think the risk to mortgage rates, the risk to these stocks is actually on the upside rather than the downside, because the surprise, the interest rate surprise, if anything, would be that rates don't go up as quickly as maybe people are thinking right now.
Right, and we're seeing that right now where the 10-year can't even get above 3% at this point. Now, Dan, they talked about input costs rising, underpinning inflation, but we're not seeing it in the data, right? And that was part of the reason a lot of these home builders' margins were getting squeezed a little bit. The Toll Brothers, Pulte Homes, PHM, D.R. Horton, DHI is another name in that, Lennar. So we saw margins getting squeezed on a lot of these companies. Do you see that continuing where maybe input costs are going to create more headwinds for this sector?
It's certainly possible. Taking a look at this chart of random length lumber futures here.
Take a look at that. Hey, Ryan, put up that chart of /LBS lumber. It hit its highest point at the end of May.
And this is a little bit what you're speaking to, where the data isn't actually showing those costs at the high and squeezing the margins. So it's curious when I'm looking at this chart as compared to the performance of some of the home builders. But if you think about it, with home sales at all-time highs and mortgage rates higher, and maybe I'm living in a place and I'm looking to migrate somewhere else, would it be more advantageous maybe to pour money in my existing home and do a remodel as opposed to...
But refis are at their lowest level since 2002. I mean, that's a concern because I think about it this way. If you got a mortgage in the last maybe 10 years, 8 to 10 years, I think it hit a low of 3.2, 3.1%. Fluctuated between 3.25 and 3.75 for a long time. Now, do you want to get out of that house? Because home prices are up there, inventories are low, but at the same time, the next mortgage you're going to get is maybe going to be 4.8, 4.9, 5%. Is that maybe something that's going to take hold, Scott? Or do you look at it this way where it's just maybe nobody's comfortable moving at this point because home prices are so high?
Yeah, I think it's more that. I mean, I think it's very difficult to say, okay, I'm going to get out because I've made 10, 15% on the equity in my home, but I'm not going to get that new mortgage because it's 50 basis points higher. So I think that's difficult. in going out in the future, Tom, and we've lived through this as being some of the older generation, Dan.
Unfortunately, we have.
Which you'll learn here in the next few years. At some point in the future, whether it's 5 years, 10 years, 20 years, we're going to see rates again probably 8-10%, like we have lived through.
Right.
And everybody that is, so concerned about my 30-year mortgage being 375 or 4, they're going to look back and say, wow, why didn't I lock in forever?
Yeah, the way that I look at it, and Ryan, bring up that chart again of LBS, which is lumber futures, right? So this is why a lot of these home builders earlier this year were complaining about their margins shrinking, right? Finding workers, right? Because the unemployment rate's at 3.8, 3.9%. So they had to increase wages. So finding skilled workers, and also those input costs rising, squeezing their margins because they couldn't pass it on to the consumer. So that LBS, I'm historically, I'm not going to say it's going to happen this time, but these lumber futures, if you look at the last couple of recessions, lumber starts dipping about 6 months to a year before that recession hits. And I don't know if this is going to sustain, but that's one of those historical data points that maybe we should keep an eye on as stocks hit all-time high. But like I said, the economy's doing pretty well right now. So I'm going to bring up Toll Brothers, guys. I just kind of wanted to discuss this one because they have earnings coming up next week, I believe, or in the next couple weeks. And let's take a look at a chart on that, guys. I've got it up here. This is a 1 year. You look at it from those highs in January where the market hit all-time highs. You're seeing this dip in Toll Brothers, and there's low inventories. Now, Toll Brothers is at the high end of the range as far as the type of house that's sold, and the biggest need is in the first to lower tiered home prices. Toll Brothers. You look at a chart like this, Scott, and you would never think that there was economic expansion if you looked at a chart like this, right?
Unbelievable. And can we overlap the lumber future chart that you just had with Toll Brothers here?
Yeah, we'll do that while you talk about it. Go ahead.
Perfect, because they're almost in sync with one another for the last 6 months, for this year here. So, I'd look at something like this and say, well, if lumber is starting to make a turnaround, if we've maybe bottomed out a little bit here, maybe that's a sign for some of these home builders that there could be a little bit of a turnaround. So, it looks here like lumber certainly happened over the last couple months, where Toll Brothers, it started, like you said, beginning of the year, right before the meltdown of the market here. But wow, the rise up and then this fall down here, they're looking pretty close together.
Did you look at this chart before? Because they are like meeting right there.
I did. I picked up on it just as we were talking here. And again, I don't know the long-term historical data of this. I'd love to see the beta on that. But maybe if we found a little bit of a bottom in lumber, maybe that's time to start picking into one of these.
Yeah, you make a good point there. And Dan, looking at something like that, I think, Toll Brothers is one of those stocks, and I've been looking at it over the last year, just kind of following it, seeing what the price action's doing. You would have thought a couple times that, hey, economy's doing well, housing prices rising. Hey, the home builders should be doing well. Where's the bottom going to come in there? And it's finally looks like it's bottomed out around that $34, $35 share level, but that's not to say that it can't turn lower.
Right, and sometimes you don't want to fall in front of it, catch a falling knife to say, but interesting opportunity with it down 24% on the year, earnings coming up, some speculation going on in the option market with the IV percentile raising to about 50%, I believe.
Okay.
So we're getting some interesting opportunity here. We have been in, that settling down period, so we could look at some type of range play. We could take a shot at maybe a bullish thing if that was our assumption, just as an example. And with the market falling, we get some of that, call skew in our call skew rising, where, we may want to look at a strategy like a covered call if we were long, as opposed to a short uncovered put. Or we could take a look at a range-bound strategy here.
Yeah. Dan makes a good point there, because IV percentile is rising as we get closer to that earnings date, which is on the 21st. It does look like it bottomed, but that's not to say that chart can't be wrong here. But as far as the call skew, and I want to kind of take a look at that for our viewers, what Dan was talking about, we're starting to see a rise in some of these out-of-the-money calls a little bit, not much, but it's it's flat to a little bit higher in some of these strikes. So, you know, what Dan's saying is if you think it's a bottom, there's ways to play it. If you think that it's got more room to run to the bottom or to even lower, maybe down to that $30 share level, you can take advantage of maybe selling call verticals, or like Dan said, looking at a covered call. It pays a 1.22% dividend yield. So that looks okay. You got dividend every quarter on that particular one. So it's got a decent yield for a home builder. And with lumber prices falling, Scott, are there input costs or margins going to expand? Because it got hurt when lumber was rising.
Right, and that to me is pretty key after looking at that last chart. There's other things I want to look at, but I think there's a bunch of opportunity here, different ways you could play, either saying that, okay, we are going to rally from here, or maybe there's a little bit more to the downside, but in the near term, we've probably bottomed out, and then look for that pop maybe coming post-earnings.
Yeah, I think the key thing with this particular sector is that you have to kind of follow maybe the overall market, because if the overall market starts coming off of these highs, maybe they're still going to be under pressure just because the overall market's going to come down. But at this point right now, that's not happening. I wanted to kind of pivot over, guys, to some trade management. Now, there's a couple positions that we've got on that I wanted everybody to take a look at. In the first one, we did a course trade the other day into earnings, okay? Where we bought 2 of the 60 puts, sold 12 of the 58 puts, and bought 10 of the 56 puts. We did an unbalanced put butterfly for an up moving cores. And I'm going to go ahead and bring up cores here on the trading platform so we can take a look at that. I believe it's still in our Analyze tab. Yeah, that was a position that we had on. I'm going to go ahead and hide in positions. But this was the trade that we did. We collected a decent credit on it. But cores spiked extremely high in this name. So that's actually good for us if you look at that Analyze tab on that particular position. Cores has spiked up above here to 72, and our break-even point wasn't until about 57.5. So how do we manage that trade? We've only got 1 day to expiration, so you've got some time in it. I've got to increase these strikes a little bit so we can see all of them. But this is basically the put that we're short. Now, there's ways that you can just let this go out at expiration because you do have over $10, $13 in cushion. Or if you just want to close it, maybe put in a penny bid for your short 12 of the 58 calls, because that would reduce all your risk. But I think we're going to let that sit because we've got over $13 of edge in that particular name moving out on that. And then one other trade that I kind of wanted to look at was, I believe it was JP Morgan. Yeah, we're short we're actually long that calendar spread, Scott, that we had discussed, I think, last week, where we're long the September 7th and we're short the August 17th put, and that's at the 116 strike. So let's go ahead and look at JP Morgan and see where that is. And our positions, the nice thing is that they come up right here. So we're long this series and we're short the August 17th. Stock's right there at our strike, Scott. Looking good so far. We've got 8 days to expiration to let that time decay work in our favor on our short strike before we have to buy that back. So we're pretty comfortable with that. We've still got about 60 cents in premium in those puts. So we're going to let that go for a couple days, I think.
Do you have the crystal ball to say, okay, next Friday expiration, we're going to be sitting at 116?
If I had a crystal ball, Scott,
right?
How many times have we said that in our careers, right?
So that brings up an interesting point. What is your exit strategy, Tom, on a calendar like this? Because let's say it is sitting 116 on expiration. Yep. That Vega is going to hold, right, to the last 10, 15 minutes of the day.
Right.
So what are you looking
typically
at?
We like to look anywhere, like I'm rolling calendars. If I want to buy my short strike back, and in this example, JP Morgan, I'm short the August 17th, 116 puts. I try to wait anywhere from maybe 2 to 8 days from expiration. The ideal spot is to wait until expiration day and hope that JP Morgan's right at 116. But sometimes we know that doesn't happen, Scott. So if there's a fall in volatility, maybe we'll want to roll and reduce our risk earlier than normal. But if you're comfortable, maybe the stock moved away from your ideal strike, but then moved back. Maybe you roll if you got 4 or 5 days out. It basically depends what your outlook is on that stock over the duration that you have left until you have to roll. Now you can close the whole calendar, or you can roll the next weekly cycle, or roll it to 2 weekly cycles. It depends on how much risk you want to take off. But I think it's a conversation that you learn from experience, and that's kind of what we're trying to get at with the trade management segment here. Is as positions that we put on, we kind of want to show you what we're doing on those particular positions and example trades, just for our viewers to get more comfortable with trade management. That's a great question. I appreciate it. All right, guys. I want to thank Scott. I want to thank Dan for joining me today. That does it for Fast Market. Tune in tomorrow, again at 10 a.m. Central Time, right here on the TD Ameritrade Network. Have a great day, everybody.